What if the real origins were quietly building for decades, hidden inside policies nobody questioned, financial products nobody understood, and risks nobody wanted to talk about? And here's the real mystery. If we truly learned the lesson, why do today's economic warning signs look disturbingly familiar? Stay with me, because in the next 14 minutes, you're going to see the 2008 financial crisis like you've never seen it before. As a chain reaction of human decisions, incentives, and ignored alarms that almost collapsed the world. To understand how the world unraveled in 2008, we must rewind not to 2007, not to the early 2000s, but all the way back to the 1980s and 1990s. The global financial system was changing. Two powerful forces were reshaping everything. Deregulation. Governments lowered financial rules, believing markets could self-regulate too. Financial innovation. Banks created increasingly complex products that few people fully understood. These weren't bad ideas on their own, but together, they formed a perfect storm. Alan Greenspan, the longtime chairman of the Federal Reserve, played a crucial role. He championed loose regulation and low interest rates, confident that markets wouldn't act against their own best interests. But markets did, and with devastating consequences. Throughout the 1990s, a quiet assumption took hold inside Wall Street. Housing prices never fall. This belief would become the foundation for trillions of dollars of investments and the root cause of the financial catastrophe. But the twist, almost nobody questioned it. Let's break down the chain reaction, step by step. Step 1. Low interest rates create the perfect bubble after the dot-com crash in 2000 and the 9/11 attacks. The Federal Reserve slashed interest rates to historic lows. 1. Borrowing became cheap. Saving became pointless. People wanted to buy houses. Banks wanted to lend money. Wall Street wanted more debt to package into investments. And so, the housing market started to rise. Slowly at first, then explosively. Step 2. Banks don't just lend, they push loans traditionally. Banks were careful because they held the risk. If a borrower defaulted, the bank lost money. But in the 2000s, banks discovered something new. They didn't need to hold the risk anymore. They could sell the loans to Wall Street. Wall Street would turn them into bonds. Investors would buy them. This process was called securitization. To banks, risk magically disappeared, so they made more loans faster, riskier, and with fewer questions. These were called subprime mortgages, loans given to people with bad credit, unstable income, or no savings. Still, the system rewarded it. More loans meant more bonds. More bonds meant more profits. The machine was working, until it didn't. Step 3. Wall Street creates a monster. CDOs. Wall Street didn't stop at bundling mortgages. They took bundles of bundles and created collateralized debt obligations, or CDOs were sold as super safe investments, even though they were made from risky mortgages. Why were they labeled safe? Because rating agencies, Moody's, S&P, Fitch gave many CDOs the highest possible rating, AAA. It was the financial equivalent of calling junk food healthy because the label said so. Why did the agencies do it? Because they were paid by Wall Street, a conflict of interest built directly into the system. But nobody questioned it. Not yet. By 2004, millions of Americans were buying homes. Prices were exploding. A house in California that cost $300,000 in 2000 now sold for $600,000 or more. People were confident. Banks were ecstatic. Wall Street was printing money. But there was a problem. To keep profits growing, the system needed more mortgages, and the good borrowers were running out. So lenders went deeper into risky waters. No income verification loans, ninja loans, no income, no job, no assets, adjustable rate mortgages with low teaser rates, 0% down payments. If you could breathe, you could get a mortgage, and the banks didn't care if you could repay. They weren't holding the loan, they were selling it. Wall Street didn't care either. They were slicing and repackaging the loans. Investors didn't care, they trusted the AAA ratings. Everybody's incentives were aligned toward disaster. The warning signs started small. In 2006, housing prices stopped rising for the first time in a decade. Not falling, just slowing, but slowing was enough. Remember those adjustable rate mortgages with low teaser rates? Millions of them were scheduled to reset, meaning monthly payments would suddenly spike. Homeowners who barely afforded their teaser payments began to default. At first, it looked like an isolated problem, a few foreclosures here and there. But under the surface, the cracks were growing. Effect 1. Subprime defaults spiked. By early 2007, mortgage defaults began rising sharply. The subprime market was collapsing. Effect 2. CDOs start losing value. CDOs, once considered safe, suddenly became uncertain. Investors panicked. Effect 3. Banks realized they don't know who holds the risk because the system was so interconnected. Nobody knew which banks held toxic assets. Trust evaporated. Banks stopped lending to each other. And in a financial system, trust is oxygen. Once it disappears, everything suffocates. This is where everything breaks. March 2008, Bear Stearns falls. One of the largest investment banks collapses almost overnight. The government steps in to facilitate a sale to JP Morgan. Panic spreads. September 2008, Lehman Brothers collapses. For AM, September 15, 2008, Lehman Brothers, a 158-year-old financial giant, declares bankruptcy. This was the moment the world realized the crisis wasn't contained, it was global. Effect: confidence collapses worldwide. Stock markets crash, credit markets freeze, banks stop lending. Businesses fail, millions lose jobs, millions lose homes. Lehman's fall triggered a chain reaction that spread across Europe, Asia, and beyond. AIG, the company that almost ended the world. AIG, one of the world's largest insurance companies, secretly insured trillions of dollars of risky financial products. When the products failed, AIG couldn't pay. If AIG collapsed, the entire financial system would have followed. The US government stepped in with a $182 billion bailout. The world had officially entered the worst financial crisis since 1929. The numbers are staggering. Over $19 trillion in household wealth destroyed. 8.8 million jobs lost, 10 million homes foreclosed. Global trade dropped 12% within months. Stock markets lost half their value, but beyond the numbers, the crisis shattered something deeper. Trust. Trust in banks. Trust in politicians, trust in the financial system itself. People lost life savings, retirements, and homes, often through no fault of their own. And while governments rescued banks, ordinary people paid the price for years. After the crisis, governments passed reforms, most notably Dodd-Frank in the United States. The goal was simple: prevent another 2008. But did it work? Partially. Some risky derivatives were regulated. Banks had to hold more capital. Mortgage standards improved, but many deeper problems remained. 1. Too big to fail, banks got even bigger. 2. Wall Street continued creating complex financial products. 3. Housing prices began rising again within a few years. 4. The global economy became even more interconnected and fragile. And perhaps the biggest issue, the incentives never changed. As long as profits are private and losses are public, the game continues. Here's where things get uncomfortable. Look at today's economic landscape. Global debt is higher than in 2008. Asset prices are inflated across housing, tech, and stocks. Banks still rely on complex derivatives. Central banks have kept interest rates extremely low for years. Wealth inequality is at historic levels in many countries. Financial systems are more fragile, not less. The patterns are hauntingly familiar. In fact, global debt hit $315 trillion in 2024, the highest in human history. Housing prices in many countries now exceed even the 2008 peak. Corporate debt is at record levels, and governments, once the rescuers, are themselves drowning in debt. So, did we learn anything? Or did we simply delay the next crisis? Takeaway number 1. Crises don't start when they explode. They start when we stop paying attention. 2008 began long before 2008. Bubbles are built slowly, silently, almost invisibly until they burst loudly. Takeaway number 2. Incentives matter more than regulations. People follow incentives, good or bad. As long as the system rewards risky behavior, risk will always return. Takeaway number 3. The global economy is far more fragile than it appears. We live in a world of interconnected financial systems. A crisis in one region can echo everywhere. Lehman Brothers proved that a single failure can shake the world. The 2008 financial crisis was not the last time the world will face a collapse. It was simply the most recent reminder of how delicate and interconnected our global financial system truly is. The real question isn't will it happen again, it's are we ready when it does. If you found value in this breakdown and want more deep, clear explanations of global financial events, economic mysteries, and hidden systems shaping our world, subscribe, drop a like, and share this video with someone who wants to understand how the world really works. Thanks for watching.